Hi, and thanks for joining us at Street Smart Options for another video today. Today, we're going to be talking about options trading explained. So, we're going to be explaining some of the basics behind options trading. And, folks, if you haven't already, hit that subscribe button on YouTube. If you're watching us there on YouTube, give some consideration to hitting that subscribe button because you don't want to be missing videos like this. They're going to be able to help you out with the basics of trading as well as the advanced principles of how to really make money with your trades. Jonathan and I talk a lot about that right here on our YouTube page. We also talk about that in our Facebook group where you can join for free. So if you go to our Facebook group, if you go to Facebook, you can search for the group just by putting in the letters SSO, and that'll pull up the Street Smart Options group. Feel free to go ahead and submit to join. It is a closed group, but feel free to submit to join, and we'll get you approved and get you in there. So today, Jonathan, you're going to be talking about Zendesk and whether or not we could be doing a trade with that, talking about options trading and explaining how that works. And it's all yours, Jonathan. Take it away.
Thanks. So yeah, we are at Street Smart Options, and this is the website I have up here. And people get involved in options, and they get a little bit overwhelmed. Maybe the first thing they do is they go to Wikipedia, right? And Wikipedia, you can look at the Black-Scholes equation for how to calculate option pricing, and it's a bunch of advanced math, and you can read through here, and you can kind of get lost in all the math behind how to price an option. And there's volatility, and there's interest rates, and there's how the option responds to prices of the underlying. It gets pretty complicated. So people get a little bit lost, and you can maybe go to Investopedia. You can look up, well, what does all that mean? Go through all the pricing and Black-Scholes formula, what it all means. And you can even Charles Schwab has a pretty detailed description of those Greeks, those delta of the on that Black-Scholes formula. There's things called Greeks, right? And so you can go to Charles Schwab. You can look up, okay, what are the Greeks and what do they mean? There's four Greeks. There's delta, there's gamma, there's theta, and there's vega. Five Greeks, and there's rho. And so you look at that and you say, oh my gosh, this is complicated. And you know what? It is complicated. Doing all that is complicated. But there's a simpler way to trade options than having to worry about all this stuff, all that math, right? And all that, all the Greeks and all that. And the simpler way is simply to find the underlying that is going to perform in a certain way, and then buy an option that benefits from that underlying performing in that way. So, for example, if we want to do a directional trade, which would mean we think a stock is going to go up or it's going to go down, let's find a stock that goes up, that we expect to go up or down, that's at a good point to buy, and then we can leverage our purchase by using an option. So, one of the stocks that I found recently, and I found it using this website called Market Chameleon, which has a screen called the top implied volatility gainers. And this top implied volatility gainers, you scroll through here and you can look at charts of these gainers. And I found a stock called Zendesk, right? And Zendesk had a 13.3% increase in the implied volatility for the March 15th option, or in the March 15th option. So implied volatility essentially means that people expect the stock to have a big move, and it's increasing recently. And the option volume is also increasing in this thing. So a combination of options trading volume and implied volatility increasing is a good sign that there's some big money thinking that this stock is going to move. And so what does this thing look like on the chart? And we can actually go look at Zendesk right now, and we can see that the option trading volume was 39.75, and the 90-day average is only 15.83. And we can see that the implied volatility, that's been increasing recently, right? It was, I should say, increased on Friday. So, let's look at what Zendesk looks like on the chart. Now we're looking here at the weekly chart of Zendesk, and it goes back to 2015. This is where it starts as like a 4-year chart. The stock is, by the way, Zendesk, just to give you some background on the company, they are a software company. They're a software as a service company. They provide their flagship product is described in the description here is a Zendesk Support, which is it's a tool that companies can use to help their customers and their support desk, right? And so it semi-automates that and makes it really easy for customers to get like email support, and they offer chat support and all this kind of stuff. And customers can find frequently asked questions, and it's really convenient for companies, and it's just well organized, looks good, looks clean, looks professional. And now the company's expanding into all kinds of other things outside of Zendesk Support. They have all these things like Zendesk Chat and Talk and Zendesk Sell, and they have this Explore and this Connect, and so they're doing a lot of other things now that are software as a service products, and they're a public company, and they have the resources to develop all these new products. So it's a popular platform, and the stock itself has been in an uptrend since November 2017. It went from about 32 to 72, right? So it was more than double over the course of about a year. And then in this recent market correction, it actually started early. The market didn't start correcting until like December here, but this stock went into this like basing pattern beginning in September. It's had this really nice long base where the people took profits on this move. New buyers came in, found support. If you look at this base, it's very constructive, and this it comes back to finding the right stock, right? The right stock that's going to make a move that you can benefit by trading options on it. And you look at this stock here, and it fell, pretty hard here on volume, but then it had like these tight weekly trading weeks where it closed around the same price for 3 weeks in a row. That means some big institutional buyers are coming in supporting the stock. And if you look here, it shook out intra-week here and then came back during the week and regained and almost closed right around, in that area. So the 3 weeks tighten here, which is really, really positive. And then the stock popped up. And then the stock has been on a rampage off this bottom since December, pretty much straight up, and had broken to new highs and has since on this huge volume spike. Look at that huge volume spike, more new buyers coming in, and has since then consolidated in this tight little area again. You got these tight little trading areas, so it didn't give back any of those gains. Of course, the market's been strong too, but this stock has not given back any of those gains and has traded tightly for 3 weeks in a row. And now is actually, looks like a really good time for this stock, kind of a low risk entry point to go long on this stock, and you can leverage that position with a call option, right? And my personal preference is to buy a call option in here that would be like a deep in the money call option, maybe like the 60s, right? Maybe go 3 months out on the 60s, so that would put you into March, April, May. Maybe the May 60 call options. And that would have like a little less time premium than if you went at the money, you actually have a little more risk because the at the money options are going to have higher premiums in them. You're going to pay more. And if the stock doesn't do anything for the next 3 months, you're going to lose quite a bit because that time premium is going to decay. Whereas the deep in the money $60 call option is not going to have that much time premium. So, you're not going to lose that much if the stock doesn't do much. But what it does do is it leverages your position. Now, leverage, of course, works both ways. If this doesn't work out, the market takes a tumble or something, you're going to want to get out of this position because you have this $20 buffer in here that will go away if the stock starts to decline, right? So you're going to want to have a stop loss point when you get into this position. But a 3-month trade leveraged on here, right now, looks like a good idea. And it just comes back to that idea that we started here, right? Black-Scholes equation and all the Greeks and all that, and it just comes down to finding the right stock at the right time, and you can buy it. And this is a low risk trade simply because you can control your risk. You have a very clearly defined stop loss point here. And if the stock starts trading below this well-defined 3 weeks tight area in here, which is the low area is around 75, if the stock starts trading below 75, you get out of your position. Very simple, very straightforward. and you get to leverage your position with a call option. So, I hope that explains a little bit how you can trade options in the real world and not have to worry so much about, all these Greeks and all this math that it can send you crazy and make you pretty lost. And just simple, focus on the simple things. Find the right stock at the right time. It's a good company, and institutions are pouring their money into it. And now's the right time to get involved. All right, that's really all I want to say about options trading explained.
All right, Jonathan, thanks for that. So, folks, if you've heard enough and you're enjoying all the free information that we give out here on YouTube and on our Facebook page and our Facebook group, feel free to just go ahead and join us over at our website, which is streetsmartoptions.com, where you can find out about us and find out about the products that we offer. Thanks, and have a great day.